Next, we'll look at the separation of the operating aspects. So we've moved from the left side, which is traditional, with ratios and disaggregation, to liquidity analysis, and then now down to vertical and horizontal and common sizing. So on the right side, we're going to now dig deeper into operating and splitting it out from non-operating. So we saw ROE, and now we're going to break it into what do you make from running the business? We'll call it operating return. And what do you make from non-operating return? And the chapter in the book has an appendix that analyzes down to numbers and percentages the non-operating return. I will not hold you responsible for that. My focus and our focus should be on the operating return. So I'm okay with doing this by subtraction. In other words, compute ROE, compute the operating return, and by subtraction, figure out what is non-operating, and without doing the full derivation. And again, you'll see that usually that's good enough. And so operating return has a very different calculation, and just to warn you, it's complicated. The numerator is net operating profit after tax, and this takes multiple steps to get that one number. The denominator is net operating assets. Again, it sounds easy, but it takes multiple steps to get that number. So hang on to your hats. We're going to be digging through line items of financial statements. So ready? Operating assets. So net operating assets. So first word is net. Net means, in this case, subtracting the liabilities from the assets. Which ones? Not just any ones, the operating ones. So you'll notice that on this chart, there are words in red and words in black. The words in red are operating. The words in black are not. So just to, instead of going through each one specifically, let's say we're looking at the asset side of the balance sheet, and you say, what's not operating? Like, doesn't it seem like most assets are used to run the business? Okay, let's say what's excluded from operating assets. The first is cash and cash equivalents. So cash and CDs, right? That's an example of what that is. You might argue that cash is needed to run a business, but the assumption here is that there's a small amount of cash necessary to just keep things rolling, so we're going to exclude all of it. It's simply an assumption, so I won't argue it too vociferously, but they're saying that in general, more cash is excess than is required, so they make it excluded. Second is investments, and these are marketable securities, and it could be short-term or long-term, and think of these as stocks, and bonds, that you just park the money there hoping to make a little investment yield, but it's really not needed for your business. You're just hiding it there for a rainy day or to buy another company. Third are discontinued operations. This is a technical area, which is saying you're in a number of businesses, but you've decided to exit one or more of those businesses. Well, if that's the case, don't count as operating, because that was your past, not your future. So that's why we exclude things that relate to discontinued operations. You'll see this all over the place, on assets, on liabilities, and in the income statement. So whenever you see the word discontinued, that's a big red flag to say, okay, that's non-operating. Next is financial assets. And financial assets mean where you're kind of like a bank. And so if you loan money to somebody, you're not running a business, you're acting like a bank. Examples of this is a loan receivables, where a customer doesn't have money to buy something from you, so you say, oh, pay me over 5 years if you pay me interest. So now you have two hats. One hat is you're a maker and seller of products. The other hat is you're their banker. So what this says is, well, don't count that receivable as if you're running a normal business. You just became a banker. So exclude it. Finally, derivative assets. And we'll get to this later on in the book. And it's quite complex, the area of derivatives, but these are types of financial assets. Let's just call it that for now. We exclude it. So we exclude these categories of assets. Now, go to the other side, liabilities. So liabilities, some are operating, like accounts payable, right? Vendors loan you money, fine, that's operating. But if the loan comes from a financing company, then that's a decision of how you're financing the business and not just normal operations. Examples: any debt from a financing source, a note payable from a bank, a bond payable from the bond markets, or a capitalized lease obligation. Capitalized lease obligation is, again, very technical, and we'll discuss it later on when we deal with non-owner financing. But for now, just when you see capitalized lease obligation, red flag, that's a non-operating liability. Now, those of you who are very inquisitive look on the left side and say, wait a minute, capitalized lease assets is an operating, and yet capitalized lease obligation is non-operating. Why are we inconsistent? Well, it's like you need a truck. You could buy a truck with cash, and then you have a truck. Or you could lease a truck from a leasing company and have a truck. So a truck is an operating asset, but how you chose to pay for it is a financing decision. So if you decide to finance it through a leasing company, that's a loan, and that's non-operating. All right, then we have dividend payables. That's not operating. You're giving the money to your shareholders. Fourth is discontinued. There's that word again. Any liabilities from that are also excluded. And finally, derivatives. Same thing. It's a financial transaction or financial obligation. Don't count that. So those are excluded. Now, a little ray of sunshine. There's the easy part. Equity. Exclude all equity because by definition, it's not an operating liability. It's how you financed it, the company. So if we take a balance sheet and we look at all these things in red and we pluck those out and we subtract the operating liabilities from the operating assets, we get NOA. So that's what I'm saying. Whoa, we're in the weeds having to dig through line items to get one number, NOA. So let's look at Intel as our example. So what's in red are operating, what's in black are non-operating. The thing I wanted to point out is look at all the stuff in green for 2015. This is all like extra money. They have cash and equivalents. Okay, that's $15 billion. Then they have short-term investments. That's $2.6 billion. Then they have trading assets, and we'll learn what that means, but that's also a form of security. That's $7 billion. And then they have investments in marketable securities that are long-term. That's $6 billion. And they have other long-term investments of $1.9 billion. So in all, they have $32 billion in cash or in pretty marketable assets. So that's 32 billion out of 100 billion. So about 1/3 of all the assets of Intel are there at their disposal. That's a powerful company. So if Intel wants to buy somebody, in general, they can afford it.